Welcome to this webinar, everyone. My name is Kamal Manocha. I represent PMS AIF World. Another Friday, another webinar. We have a new guest. We are doing this webinar for the first time with this guest. I will just, first introduce this guest to you and then, give the context to this webinar. We have Mr. Sandeep Daga, who is the managing director and CIO with Nine Rivers Capital. Nine Rivers Capital is well known for doing small cap focused, micro cap focused investing. He brings with him more than 2.5 decades of experience. He has worked with ICICI Ventures and has been managing public money under Nine Rivers Capital for more than 15 years. And the returns have been kind of like something we call as 10x over 10 years or more than 10x over 10 years, because obviously, returns have been upwards of 26% since inception. So, today, the context of this webinar is to actually understand why the speaker believes that today is the time of actually not ignoring, but focusing the space of small caps. Though on one side, everyone is talking about recession in the West, the global turmoil, but at the same time, obviously, we are talking about India in the bright spot. And we also firmly believe in that this decade belongs to India. And, in this decade, from maybe 3.5 trillion economy, we could be 6 to 7 to maybe more than that as a 6 to 7 trillion economy. And obviously, in that context, many small caps could become mid caps, and many mid caps could become large caps. And doing that discovery at such time looks to be a contrarian call, looks to be a difficult discovery, but it's not impossible, and hence it is worth talking about this. And that's the context of this webinar. And for that, we have Mr. Sandeep Daga to kind of give us his learnings, his wisdom, as well as a lot of data points which kind of point towards this discovery. Welcome, Sandeep. From I would say formal welcome to you, because you are coming to this platform for the first time.
Thank you, Kamal. Thank you. It's my pleasure to be here on your platform. It's one of the most credible platforms in the PMS and AIF alternative investment industry. So it's my pleasure.
Thanks, Sandeep. So, over to you. I think, you have a presentation to kind of share over the first half of, this around 1 hour of conversation. And then, once your presentation is done, we will take questions and answers. To everyone, once again, a warm welcome to you. You are most welcome to ask whatever questions come to your mind. We want to keep it educative. This is not I would say, a session where we are trying to sell a product or we want to advise on investing in small caps. Not at all. The idea is to learn, to kind of understand the context, and if any questions come to your mind, most welcome. We'll take most of the questions which come on the chat box. Over to you, Sandeep.
Thank you, Kamal, once again. Good evening, everybody. While Kamal has already made this disclaimer, but I am also duty bound to make this disclaimer that I'm going to make a presentation where we may be covering some aspects of our PMS, but that's more to share our thought process, and that's not this is not a platform for solicitation of clients or any kind of selling that that, as Kamal mentioned, this is more for sharing our thoughts and maybe for you guys to take a few leads from here and use it in your own investing journeys. I have always been asked this one question, that what is this private equity approach to small cap stock picking? Because that's our tagline. So during this presentation, I'm also going to cover that aspect a little bit, and I do believe that makes small cap investing that much more interesting. I'll start the presentation now, and then as we go along, we will. And Kamal, please be my timekeeper. If ever there is if there is an overflow of time, just warn me, please.
No worries. Sure. All the best.
Yeah. Are we live with the presentation?
Yes, absolutely.
Great. Thank you. So just a little brief about us. We have been around for 15 years, public markets last 10 years, and focused on small caps. Perhaps makes us one of the oldest exclusive small cap focused fund house. Before we actually talk of small caps, I think to build this case for small caps in a world where there's a lot of turbulence globally, India obviously stands out. We should consider some macro data points on India, and that can then lead to why, what kind of a strategy one should have when it comes to small caps. So here we all know India is our fastest growing large economy. So this is something which I think I don't need to emphasize. But what also is important is now the credit growth is at a decadal high. See, after many years, we've seen actually the credit growth, especially the wholesale credit growth, because from last many years we've seen the retail credit side uh, taking away all the glory, and the wholesale credit that goes to corporates, to businesses, to SMEs was always has been a laggard. Now this itself is suggestive of the confidence of entrepreneurs to make newer investments. They are, when an entrepreneur assumes debt, and especially after IBC has come, they have to be supremely confident about the prospects of the business they are in, to make these kind of, so, and largely still it is working capital driven credit growth. We are yet to see, but I'm quite hopeful that we will also see credit growth which will be more of project finance kind of credits that will now get doled out, whether it is directly by the banks or through issuance of longer term NCDs, etc. So we will this is a very important aspect which we should consider when we are looking at India and growth. The entrepreneurial confidence stems from this chart. uh, you know uh, we talk about inflation and interest rates. Now if you see inflation of the US and India, from what it was 3 years ago and what it is today, we realize that we are in a much better position than the rest of the world, and especially the US, when it comes to the threat of interest rate rise leading to recession. We are not in that boat. And as you can see in the the benchmark rates today are almost the same as they were in 2019. There has been just a slight increase, while for the Western economies and the US it has been a huge increase. So that itself again shows we are in a much better situation to absorb the minor interest rate rises that have taken place in our country, and perhaps likely to plateau out soon. We all know GST collections have been very robust, so I don't need to emphasize that. But the idea is that if the GST collections continue to build, then the government's elbow room to spend on growth, through infrastructure spending, through all kinds of spending that the government does, that also remains intact. Otherwise, it basically will get impacted and the government's balance sheet will start getting stretched. This is a very interesting chart. So this is courtesy, Morgan Stanley released a report just a few days ago. So we've just picked it up from there, of course, giving them the due credit that it's their chart. In China, the once you hit a certain, once you hit that tipping point from where the GDP growth doubled in 4 years, and we believe we are at the same point, same tipping point what China was in 2007, and then it saw massive growth. We being a democracy, we may not see that steep a growth curve, but still, if not in 4 years, in next 6 to 7 years, our GDP should double, and that is what that's what makes India stand out today vis-a-vis the world. It is not just right now, but going forward into next 5, 6, 7 years, we are going to see a fantastic quality growth on the back of deleveraged corporate balance sheets, reasonably good on a relative terms. I'm saying good government balance sheet and government fiscal situation, and the fact that the all manufacturing as an opportunity has opened up in a big way, which will lead to private sector capex revival. So these are important parameters on the basis of which we can say that at least we confidently say, we've been talking about this, that India for the next 5 to 10 years is going to see a very good economic growth will be very good. Now whether we hit that double digit number or not is a matter of few years, we may, but otherwise also we are going to see extremely good economic growth. Why? The next chart, as you can see, how the profile of in the next 10 years, or rather 8 years, how the or income distribution will change, and just see this middle layer on the right side, which basically there's going to be a huge bulging of consuming population, and that means again extremely good, bodes well for our economic growth of India. Now, oftentimes when we talk of public markets, I have seen that people emphasize on the monies that flow into the via FPI route, monies that flow into the market, and the FDI aspect, often gets underplayed. It's our strong belief that we will be seeing very strong FDI flows into India again over the next 5-10 years. This year, FY22, it was 84 billion. This year, it may cross definitely 100 billion. And over the next 5 years, it can even, the FDI can even go to 150 or 200 billion dollars a year. Now, very, very important thing to understand is FDI is long-term money. FDI, whether it's coming via VCP funds, or whether it is coming from multinational companies who are setting up operations in India, and they fund their own subsidiaries or own companies or joint ventures in India. The idea is that this money comes in, stays in the country for a very long time, long horizons. The money has a huge multiplier effect. And as our tech economy is now, well matured from pure services, now we are, we are getting into IP creation. And for example, we talk about the India financial stack. We know we are cutting edge. When it comes to other many SaaS offerings, we are cutting edge. We have seen, several other IP from the banking financial side. We have seen companies, giving out solutions which are IP based, intellectual property based, and not pure services. Now, this has been possible because over the last many years, now India has a very, very strong tech and new age businesses, a startup entrepreneurial system where you get right from the day you need seed capital to Series E and Series F fundings are happening. This is all very long-term FDI with a huge, huge multiplier effect. Think about this money coming in, going into employment, going into buying houses, going into buying cars, two-wheelers, etc., being spent on travel and tourism. So this is a very big driver which has a long-term impact, and we often miss this out. So I wanted to share that why India will grow. These volatile times in the markets may remain, but the FDI is consistently growing, and my view is that it will now get fast forwarded. Mind you, in the 20 years of Chinese growth, it was basically the FDI which pumped up the Chinese growth. So we are basically going to see something similar happening in our with India as well. So now we'll come to trying to see that there is a big opportunity at India macro level. We are going to see economic growth, notwithstanding sometimes there'll be oil price hike, and some other times there'll be something or the other will spook the markets for short term. But from a fundamental standpoint, we are likely to be very, very robust, and we'll be able to weather those small time periods of panic very, very easily, is what my submission is. So then the question that is often asked is that in small caps, why to invest in small caps in the first place? Because large caps are safe, and small caps in a very generic way is a very volatile universe. You have all kinds of companies. A lot of companies go out of business. A lot of companies are very shoddy. So why should you invest in small caps? So the issue here is, it's not about whether the company is a small cap or a large cap. It is about the quality of the business, quality of the people who run. As we go down the slides, I'm going to show you 5 stocks of current Nifty 50 where small caps just about less than 15 years ago. So the idea is that these are the companies who have seen humongous growth, and they now are a part of not just large caps, they're a part of Nifty Index. So it's about, even though business may be small, it is about the future potential to scale up the business. That warrants investment in small caps. And what is important is that companies that can consistently grow faster because of external macro tailwinds or the unique business that they have. For example, a tech company may have a unique technology which can grow non-linearly for a very long period of time. So this is what makes the case for investing in small caps. Uh, Typically, what makes a good quality small cap idea? So, as I said, small, they may be small in size, but the market that they address is very large, and they have some, uniqueness or some niche that they address, which basically has sufficient value addition. And obviously, this is the less discovered universe. So, a lot of these companies don't come on the radar of larger investors till they have really scaled to a certain level, and they have shown their earnings visibility is now available to the earnings growth has become visible to larger market participants. So the idea is to capture the discovery premium and invest ahead of the rest of the larger market investing in those businesses. Now, if you can see this, this is a chart which is plotted from 2006-7. The Nifty line and the small cap 100 line, as you can see, they converge from time to time. In fact, when it peaks, it basically small cap index beats the Nifty's growth, and then of course wherever the markets tank, there is also a sharp correction. So we can see this happening in 2008. We can again see this happening somewhere in to financial year 17-18. In that the small cap indices peaked and they went over, and then from then the next couple of years where all these ILFS and DHFL scams broke out, and there was this huge divergence between Nifty performance and small cap performance. COVID again led to a balancing, but since then again we have seen that there is this divergence between Nifty and small cap index performance has widened again. Now we have seen this every time this happens, after that there is a catch-up phase and usually the small cap indices will overshoot the Nifty over longer periods of time. That happens. So that even from a market standpoint, while the indices look at a new high, but the gap between Nifty and the small cap index is still very high. What it suggests is that the small cap index is a lot to catch up. If history is any indicator, there is so much of a catch up in the offing, and that also makes the case for investing in small caps. So again, another reversion to mean. Here you basically it's trading 33%. So another graph, but the idea is to show it's, even reversion to mean would mean that there is so much of potential left in the overall small cap space as such. So as I was telling you, there is this these 5 companies, both Bajaj Twins, Britannia, Eicher and Shree Cement, in April 2009. So as I said, it's just about 13 years now. They were all small caps. Look at their market cap. And one of the things that, often people say that, okay, small cap index, but small cap index sees the highest amount of changes. All good companies from the small cap index migrate to become mid caps. So they go out of the index. Then there are few who become large caps, as we saw here, and this happens over a decade, sometimes less than a decade, but typically over a decade, good quality small cap companies tend to go and become large mid caps or even large caps. So when we look at small caps today, the good companies or the gems from there have already moved over the last 5-7 years. We have to pick up the new gems, and those gems are again likely to move. So looking at small cap index in isolation has no meaning, in my opinion, because the good companies from that index move up and they no more represent the small cap index they were a part of earlier. So here are a bunch of mid cap companies who have all done extremely well, and they have given phenomenal returns, and all are extremely credible names. So all these companies, I'm not going to read it out to you, but you can see on the screen. So this is what, though the small cap universe is considered to be risky and volatile, this is where we believe the private equity approach aptly suits, it's apt for small cap investing. Now, what is this private equity way of investing? So this is our thinking. There is no standard definition. So the private equity approach basically constantly nudges or pushes us to look beyond past numbers and anticipate the future of a target company, which is overarched by positive industry or sector tailwinds. So we will cover this aspect as we go, in greater detail. Even I have included one or two illustrations in this presentation. So what are these key tenets of our private equity approach when we go about looking for investment opportunity? First thing is we invest for the long term. Our average holding period is 5+ years. So we want to invest in companies which have, where we see growth prospects for a horizon beyond 5 years. Second aspect is that we want to catch an investment thesis early. As I said, there is an opportunity to capture discovery premium. Now that you can capture only if you can try and get into an investment thesis early on, before the larger market participants or institutional participation comes in big time. So this is something which, because I come from the private equity investing background, and so does my partner. Both of us have done private equity investing in our formative careers. I mean, I was for 1.5 decades, I did private equity investing. So this is something which we've kind of been able to build inside our teams in terms of doing, inventive thinking, forecasting, and trying to anticipate what changes are going to happen and how businesses are going to be impacted, and then go and try and pick up some companies where there is long-term tailwind and available with other qualitative parameters that I'm going to talk about. Now, this also requires building nuanced expertise in industry segments. You can't have a private equity approach if you don't know enough about the business. And this is where, you have to leave your desks, you do your desk research, but, you have to actually go on the ground, do a lot of validation of your theses that you have created at the desk level, meet various industry participants before, first saying that this is a rock solid thesis and now let's look for a specific target company. So over time, last 10 years doing this in certain industry segments, now, we've built reasonable amount of expertise to very quickly figure out what's happening, whether the cycle is turning, what kind of a longevity this cycle would have. And this is a continuous process. As we grow and as we move ahead, we will keep building this, in more industry segments. A very important thing is to buy growth, but only at reasonable valuation. So obviously, when you invest in small caps, you invest for growth, but investing for growth and not having sensitivity to the valuation. If you just chase momentum and buy a good small cap company which ticks which ticks all the marks 10 on 10, still if you buy that kind of a company at very, very high valuation, especially volatility happens in both sides. We've seen in 2017-18 that small caps had gone berserk. The index that we saw peaked. That happens. Whenever that happens, there is always going to be drawdown. The markets peak out. Even good companies see significant drawdown. Again, private equity approach means you build high conviction in every company that you invest in, and therefore you can't have a very large portfolio. 40-50 stock portfolio or even 30 stock portfolio means you will need a humongous amount of bandwidth to monitor those companies, and with relatively smaller AUMs that you can deploy in small caps, you can't have a team of 20-30 people looking after the company. So therefore, we believe that you do your homework, you do your 360-degree evaluation, you understand everything, but then you be reasonably confident to build a concentrated portfolio of about 15 stocks, which becomes, which is possible to be monitored closely with a team size like we have. We have 7-member investment team. So that's it. And lastly, we invest to exit. So when it comes to small caps, the important thing is that, all small caps don't make it to becoming mid cap. Only few of them graduate. even some of the ones which are good small caps managed by good people, they may hit a plateau or they may hit a saturation point. It could be because of business reasons, it could be because of leadership styles. So one has to be disciplined here about exit, and the way we do it is that we invest in a thesis. As the thesis plays out, and when it is completely, and with a 5-year horizon, but sometimes it could be earlier, sometimes it could be slightly later, but you invest to exit. Ultimately you exit and then you reinvest your money. Now I'm quite sure some of our companies that we invested in the last 10 years, many of them have obviously, when we exited, they became mid caps, but some of them may even become large caps over time, as we have seen. Companies featuring in Nifty are were small caps just like 15 years ago. So this may happen, but I don't know which one. So we have to invest to exit, and kind of same private equity like approach, then you reinvest. What do we look for top down while building a thesis? So basically we look for macro tailwinds. For example, there could be policy and regulatory tailwinds. Ethanol blending is a regular policy tailwind. RERA for real estate is a regulatory tailwind. There is a China plus one, or is actually I shouldn't call it as a policy or regulatory. It's an event which India is a beneficiary of. Wrongly placed here. Sorry about it. PLI is a scheme by the government which is driving certain manufacturing businesses. The focus on green energy, green hydrogen creates opportunities for many businesses. So this is driven by the policy and regulatory direction that the country is taking. Then, of course, there is demographics, which we all have been living with. India is a large consumption economy, and we are still, as an economy, we were to compare ourselves with China, almost the same population now, but we are still, a long way to go in terms of our consumption growing. So under which you have financials, you have various kinds of consumer goods and services. And here, when it comes to consumer goods or consumption-oriented, theme, it is also about catching a trend, either a consumer behavior changing for certain goods and services, or consumption patterns are evolving, which are long-term in nature. Then that itself, if you pick early on any company in that thesis, huge amount of multiplier follows. And then of course tech as a macro tailwind for Indian tech is now, it was earlier services. From services, pure body shopping services, I should say, is how it started. Then it went to offshore development centers. Then it went to co-product development, where you work with your clients developing. So centers of excellence were set up over here. In the last about 7-8 years, we have seen massive amount of intellectual property building by both listed companies, some of them, but a lot of unlisted companies funded by large, well-known VC funds. So funded by several VC funds, including large VC funds, the likes of Sequoia or SoftBank, etc. So this itself is a tailwind available because these technologies have a global appeal, and that once you go to and market, look at world as a market, then as a relatively small company, you can you have infinite growth prospects, at least in the short term. We look for transformative management changes in companies. Many times companies have existed for decades together, but either a younger generation or a new dynamic leadership has taken, has kind of now taken over, and that breathes fresh, energy into the business, and that allows you to then, look at that opportunity again from a long-term view, where the renewed focus, on markets, renewed focus on business efficiency, etc., will unlock value over the long term, alongside the growth prospects that the business has. And then, of course, from time to time, you do look at, where is disruption coming from, and you don't want to be coming and getting routed by disruption. You want to see the beneficiaries of those disruption. So that's where your advent of electric vehicles, or eventually we are going to see mainstreaming of plant proteins. These are areas where now we have EPR regulations, extended producer responsibilities. So these will be beneficial to certain businesses, but certain businesses will be negative impacted. So we look for top down who is going to be a beneficiary, and accordingly then build our investment thesis. Then what do we look for as bottom up in a company? So obviously, first and foremost, we look for a solid business franchise. within a certain thesis, you can have certain players who are specialty and certain players who are commodity. We obviously would, veer more towards the specialty guys who have a solid business, very solid entrenchment in their customer segments. Usually, barring financials, the other areas where we have invested in, we found that usually it's an oligopoly of two, three, four, five players. It's not, and they have their, in a large niche to a large enough market to serve, and therefore, you are able to preserve your growth and your margins both. We look for profitable growth. This is important in the context of so many loss-making companies, especially the e-commerce and the tech companies, new age tech companies that are getting listed. We believe that we want to mindless chasing of growth, will hurt long-term interests of the shareholders. So there has to be profitable growth. Even if we invest in a certain company which may not have made profits in the current year, we want to see them very clearly on a path to profitability in the next year. And that's the only area in tech where we may be a little lenient. Otherwise, we want to see profitable growth in every other business. We typically we look for operating leverage plays, where significant capex cycle is completed, and there now the industry is coming into a tailwind situation. So there is going to be better capacity utilization without needing to and by the time you hit your rated capacity, the growth thesis would have been played out. So we did this in years ago. We invested in tire companies, Seat, and we saw this. And then when the new investment cycle came, by that time our thesis was completely played out. We sold, made handsome gains. And now again, we may again look for the next cycle within the tire business. So that's how we look at when we talk about operating leverage. Different companies have. There are companies we have invested in who basically expanded their product portfolio. They already had a great distribution reach. So how does the operating leverage play out there? You are able to push more and more of your products through your newer products through your same distribution channel. We look for those kind of situations in our company. We are extremely conservative when it comes to balance sheets. We invest only in robust balance sheets. So this low financial leverage is a must for us. So barring any financial companies like banks or NBFCs where they basically borrow to lend, that's their business, all of our other companies in our portfolio, right from the inception till today, have absolutely, most of them are zero debt, but those who have some debt, maybe 30% of our companies may have some debt. That would be very minuscule. The highest debt equity ratio in any of our companies will be like 0.2:1. So that level of conservatism we look for. Now, why? Because in a growing economy, the debt can act as an equity kicker. But what we have seen is that, and this is anybody can go and do this analysis. Whenever a small cap company which was debt laden hit the when the markets peaked out or their business cycles peaked out, there was a decimation in the equity valuations of those companies which were debt laden. So for us, debt and a small cap company and debt is a deadly concoction. So you should basically avoid. By avoiding that, you are basically in a way also avoiding businesses where perhaps the entrepreneurs are more adventurous than we are comfortable in going and assuming debt, more aggressive. But debt, at least historically, every single company that we have seen, this is without an exception, that those companies which are debt laden see a massive depletion in their equity valuation whenever the markets peak out or their business cycles peak out. Obviously, as everybody else does, all of this needs to get converted into attractive financial situation for an investor. So a credible ROCE and ROE is a must. Ability to generate free cash flows from business is a must. So all this we look for in a bottom up when we have a target company that fits into one of our investment theses that we want to invest in. Every person who I meet have asked me about questions on the governance in small cap companies. There's a lot to be desired. How do you assess that? So I'm just also going to talk a little bit about how we do it. And yes, governance is very, very important. What we look for is, the it's not just governance from a corporate governance standpoint. We have to look at the overall governance. So overall governance also covers environmental side. If you are in an environmental sensitive business, like specialty chemical businesses are environmentally sensitive. If you are in a business which which basically engages or hires a large workforce, for example, IT companies, textile companies, BPO companies, then we also want to ascertain that there is a, what kind of an inclusive people policies that company has, which basically allows them to retain their talent, which also allows them to, become more efficient, because so that part is also part of governance. And of course, then corporate governance, where how your corporate actions have been, whether these corporate actions have been materially, materially would have impacted minority shareholder value. All of this goes into when we are, when we are evaluating our company, and when we are also on the ground meeting and channel checking everything. One part of that is also channel checking on the leadership of the company that we are targeting to invest in. So what kind of ethos do they carry, what kind of reputation they carry in the marketplace, with their suppliers, with their customers, etc. So as I said, it's corporate governance cannot be measured by a single yardstick. So we look at everything, internal, external, and then we kind of give a score, which is, on a scale of 10, 6 is our cutoff. If somebody doesn't come up to 6, then we will not invest in the company, no matter how good the opportunity looks. Most companies which we end up investing in have a score of between 6 to 8. And what is important to know is that, companies which say are at 8, we will be not happy if they come down to 7, although my cutoff is 6. So I'll be very happy to see a 6, somebody who scored 6 go up to 7, but somebody who's at 8 coming down to 7 is a no. It's a dilution of governance, and therefore we may choose to take an early exit in such a company, and we've done it in a few cases. So that's how we look at governance. Not all companies, this general statement that all small cap companies have poor governance is completely untrue. There are certain companies which actually, we've come across many companies, but certain companies have outstanding governance much better than the large caps that are revered for, that are kind of spoken about when it comes to governance. So it's a large universe, so therefore generically people think everything is like that. But since we only have to invest in a small bunch of companies, out of that, two dozen companies is all what our portfolio is. Any client would have 12 to 15 of this in his portfolio, but the entire portfolio is about 2 dozen companies. So of those large universe of, say, 1,000, 1,200 companies, we filter it down to about 300 companies, and from those 300 you pick up your stock. So this is where these are the companies where we feel governance is not an issue. Rather, many of them are extremely good at governance, and eventually, as I said in the very beginning, if these companies continue to do well, they will move out of this universe and get into the mid-cap zone. So therefore they will never be again talked about when small caps are being talked about. So that's about governance. I was telling you about the importance of booking. When we invest to exit. Why? Because this entire universe, listed market universe, is a pyramidal universe. On the very bottom, you have very tiny caps and penny stocks. Then you have the small caps, then you have the mid caps and the large caps. As a pyramid, only few of small caps will become mid caps, and even fewer will actually go and become large caps. So when we create a portfolio, we don't know which ones can actually migrate to the next and to the next orbit. So we believe that when you invest in small caps, it's a good idea to invest in small cap with the idea of with keeping a long-term investment horizon in mind. But when the thesis is played out, you might as well sell and reinvest. Consider reinvesting. That has worked for us, or the returns that we've been able to generate, and on a sustained basis over the long term. This is the strategy which has helped us a lot. When you invest in small caps, obviously there are red flags to be looked for. For us, these are the stay away red flags. If it's a one man show, a very centralized decision making kind of a management structure, then we have all seen that while you may have growth prospects, you have a very good macro tailwinds available to you, but the decision making is such that the man himself can become an impediment to his company's growth. And we are investing for growth, so nothing wrong with the man or nothing wrong with the entrepreneur at the top. But if you are not creating a solid second line of management, which is sufficiently empowered, you will face growth challenges which you may not be able to overcome. Or you may lead to suboptimal growth when you had prospects of growing much higher. Time and again in every cycle in the market, you will come across some Midas touch rock star managements who can basically promise the moon to the in terms of business. We don't invest in such businesses. We believe that most of this, if not all, entrepreneurs are disconnected from reality. They are underplaying risks and challenges in their own mind, and therefore they take very, very risky decisions which later come to haunt them. And oftentimes they are close to questioning. You try to ask them, to justify how the growth will come. There is a lack of clarity. It's a statement of intent, but oftentimes it is not drilled down in terms of what the exact strategy is. Why do you think you will grow so much? There are no answers. So they are basically become close to questioning. Then you have companies which see initial success, but after initial success they start to diversify in non-related areas. As if an entrepreneur wants to, from a single company, he wants to say I am a group. So suddenly you have either outside of the listed company, which we are, let's say, looking at, or within the listed company you start two more businesses, and that's again something which we do not like. So we stay away. And if ever any of our companies we are invested in goes down that path, we exit. We've come across situations where there are accounting inconsistencies and numbers not tying up with the larger story. So we've seen situations where there has been a overstating of the capex that is being done. We have seen situations where working capital, in the current assets, there are a lot of hidden, losses are hidden, or there is sticky receivables not provided for, etc., etc. So you need, if those inconsistencies are there, then there is no point in looking at the larger story and saying that this entrepreneur will be able to make it, because all this, the cleanup of the balance sheet will one day haunt them. So it has to be done. It is only about matter of whether he should have done in the past or he will do with bigger burden in the future. Too many related party transactions, promoters, share pledges which are nothing, no connection to the business. These are also red flags for us. Current times, what do we think are the investment themes? So we have select manufacturing businesses we like. As I told you, there are tailwinds available. What we look for in manufacturing businesses, again, serious value addition, not highly commoditized, leadership in their respective niches which businesses operate in. So if you're an auto ancillary and you're making a certain product, so one part is that you're not going to be disrupted because of electric vehicles. The other part is how entrenched you are with your customers. So for example, we are invested in Gabriel India, which makes shock absorbers. Now, shock absorbers are not going to go away with electric vehicles coming or hydrogen vehicles coming, whatever. Now, this is a company which has been around, very, very reputed in terms of its product quality. They have very solid customer entrenchment. So it's plus, because it serves multinational customers in India, it also has a solid opportunity for serving those MNCs in other markets on account of China Plus One. So, and this is I'm just giving it as an illustration. As I said, this is not a buy or a sell call. It's there in our portfolio, and I just wanted to highlight how manufacturing plays we look for. India digital stack. Now, when we talk about financials today, we are not a large cap fund to buy a large cap bank. So when you have to invest in a smaller bank or a smaller NBFC or any other firm which is in the BFSI space, what we look for today is how are they leveraging technology to grow faster and make their business more efficient. So to reduce your cost of customer acquisition, to reduce the process timelines, to make processes automated, all of it, plus the ability to cross sell through tech platforms, etc. So a lot of one of our recent buys, which I'm not going to talk about because we still are actively buying that company for our client. We were really amazed to see that us in this space, which are where you have giants. Here is a company which has been able to create a solid niche on the basis of their geographical reach, as well as the technology platform that they have deployed. So this is how we would love to invest in those kind of companies, and that's where this digital stack, which is coming up now. Yesterday, obviously, the central bank digital currency has been launched. So companies which are on the ahead of the curve in embracing technology, fintech to do their business is what we are looking to invest in. Defense is a good sector. We have already last 3 years we've had a company in our portfolio which is a defense company. We continue to look for, although significantly now the defense companies, all of them have gotten re-rated, but the sector is going to grow phenomenally from here. So whenever the opportunity at the right valuation presents itself, we will obviously go and invest more in this sector. I already spoke a lot about IP-led technology plays. We always the one is segment where small caps can really rapidly scale is here. So here we look for companies that have IP-led SaaS offerings or license offerings, which basically the development cycle is over, and you are basically now every penny that comes to you flows to the bottom line. Once your investment cycle is complete, then the more you sell, all of it flows down to the bottom line. Our country has actually committed itself to green energy. We are signatories to the Paris Climate Accord, and I think I was just reading this morning a chart which was pictorial, which was shared on one of the groups, that India is in terms of taking green initiatives, India is in the top 5, and the other countries are also Scandinavian. I think one is Morocco, and then 5th is India. While the West reaches us, but we are really doing a lot, and that is what also will lead to opportunities in the green world theme, as we call it. Global healthcare ecosystem upgradation. So COVID actually made the world realize that how unprepared we were when a pandemic broke out. I do believe that over the next decade, once this dust of perhaps the Ukraine crisis and the interest rate rise settles down, which I think we are now getting closer to that, democracies across the world will focus on basically upgrading their healthcare system, both soft as well as hard infrastructure on the healthcare side. And this presents a great opportunity for Indian companies, not just pharmaceuticals which have been there around, but medical devices, diagnostics, supply of nurses, remote analysis and remote diagnostics, tele-counseling, all of it will basically, they all will have world as their markets. So this is where this is not an exhaustive list. I just wanted to give you a flavor of what are the investment themes and within which we can go and today look for, and we are finding small cap ideas. Just 2 case studies from our portfolio I want to share here. Raj Industries is as we all know, is the largest ethanol plant maker, and beyond that they make a lot of process engineering equipments, water and wastewater engineering equipments that they sell to a whole bunch of customers, private sector customers also. Ethanol became a big story in post COVID. The thrust to meet that 20% ethanol target was accelerated. But we looked at this company, I think we started looking at this company somewhere in 2018, second half. And why we looked at this company is because we first did our homework at the thesis level that, if India needs to meet its climate goals, then what are some of the low hanging fruits? And one of that was to increase the blending of ethanol in petrol from 5% to 20%. And this was good economics and good politics coming together, because end of the day, sugar industry that time, go back to 2018, was under duress. The PSU banks were saddled with sugar NPAs, and government, for out of compulsion, would have to compensate the cane farmers in time. So it will push the sugar cooperatives to take more loans from PSU banks and to settle the dues with farmers, while government's own dues to the sugar cooperatives won't come in time. And the industry was going into sickness. So when we met, we were told by the industry participants themselves that if only you can if the offtake price of ethanol is increased to make it more remunerative, we will be very happy to make ethanol. And also the policy change to allow conversion of sugarcane juice directly to ethanol and not to make sugar. That can be a very big positive step. So we knew that here is a low hanging fruit. There can be no political opposition to this. This is good fiscally for the government also, because your biggest import item is crude. So the more you blend local ethanol, the less that much import cushion comes in. So we waited then for policy action, and then we bought this company. But now your important thing is, which I said, what is private equity approach? That ability to anticipate what is going to happen. So if you would have looked at, anybody would have looked at Praj when we first invested, one would see that there is hardly any, on a historical basis, there is very tepid sales growth, sub 10%. The return ratios are also look very, very, very suboptimal, because companies were always making money. So the cash and the cash equivalents were going up. And when you don't have growth, you don't have the return ratios will suffer, because your balance sheet is bulging with cash. But since we could clearly see that what capacity addition will have to happen if this 5 goes to 20, and when the policy action started, this whole entire thing was modeled with us, then we just went and bought Praj. By this time, we had met the leadership at Praj, we had understood everything, and we knew that the day this happens, Praj is the biggest beneficiary. And it is clearly a 5 to 6 year story, if not a decade long story. So that's how we ended up investing in Praj. We invested obviously at valuations which were where we were we were very, very comfortable. And from there, then there is a huge capture of discovery premium that has happened. We've still not exited. We still hold this company, but just we are about 4.5x from our investment, from where we bought. Another company this is a company which we bought in post-COVID. So Tejas Networks, and the tailwind was that China and Huawei were being shunned by all countries, from Australia on the east to United States in the west, most of Europe. So here was Tejas. Tejas has had a long history of creating communication products, which basically go in last mile connectivity of the broadband and the networks themselves. Because of COVID, the need to increase the bandwidth pipe was already there. So this would require a whole bunch of last mile connectivity products. So they were patented. So all of this, they had hired a sales team in the US. So that's where we could take a call, despite the fact that the previous year company made losses, that here this is a company, the future for this company will completely change. They will see huge growth coming in. Now, later on, of course, Tata's came, they found this as a strategic fit, they bought the company over. And now from here, perhaps there is a new cycle of growth, which was not anticipated by us, we are going to witness. So again, we are holding Tejas. It's been a very big multi-bagger for us, but we've sold 25% of our holding at one point, and then from there we are holding on current. So this is where the ability to kind of model what's going to happen, and then keep tweaking that model as the business starts to perform, and then you carry that conviction to hold on. So in some stocks can be 20, for example, Tejas Networks is almost 20x in our portfolio today. And if, at 20x, we are still holding, the conviction comes from, that private equity approach of getting deep inside the business to know that okay, this will still continue to do well. This is just our product offering. We basically invest in market cap companies up to 8,000 crores. Look for large cap quality within the small cap with a small cap growth potential. Our returns, I'm sure Kamal has already shared with you, or you know about it. Investing style is growth at reasonable valuation, top down thesis building and bottom up stock selection, concentrated portfolio, long term horizon, and early exit if needed, where if the risk rewards change. Also, I should also speak a bit before we can do Q&A, is that we have underperformers in our portfolio. Every portfolio has had underperformers, so do we. Underperformance in our portfolio companies where we had to sell out and exit have been on two counts. One is external business environment changing, and which basically is beyond anybody's control, so you need to take that call. And the other one is where despite all our effort to do that comfort building with the leadership, the style and everything, yet there is subpar execution. Now this is not related to governance. It is subpar execution also means that the leadership has not been able to manage growth effectively, and variety of reasons. We have seen situations where the professionals who were onboarded by the entrepreneur, they couldn't gel well, and therefore there were departures. We've seen situations where companies went and set up businesses overseas, but they couldn't manage that well, so that became like a millstone around the entrepreneur's neck. We've seen situations where promoters have fought amongst themselves. So fought amongst themselves. These are at the group levels, when you're a part of a larger group, and then there is some you don't have an easy settlement within the group, but then market cap of the company suffers whenever there such fights happen. So this is subpar execution. Fortunately, we've not had a lemon in our portfolio where a company went bust or got delisted or was basically penalized for unfair capital market practices. Maybe why we have been so conservative that we have been able to avoid those kind of situations. This is not to say that this may not happen in future, but our conservative approach, I believe, has helped us to avoid those kind of catastrophic situations, which also are one of the fears when people invest in small caps. So I think that's about it from my side. Happy to answer questions that any of our participants would have. And Kamal, over to you again.
Sure. Hi, Sandeep. Sure. I think you have covered everything. I had a couple of questions in my mind. I could see from chat also, but you did not leave any scope for any questions. But still, the practical questions that most investors would have on their minds today, which I think is very relevant and should be answered, is that over last 1 year, in the year 2022, though we have seen markets have made all-time highs, at the same time, if I was to analyze Nifty 250 out of maybe 250 companies, I think more than 125 companies would have actually destroyed wealth, I think very badly over last 1 year. There have been, I think, companies who would have lost value from 40% to 70% in last 1 year, right? There are many more than 30 such companies out of these, say, 100 companies which have given negative returns. And overall, Nifty 250 as an index, Nifty small cap 250 as an index would be down, I think, 8-9% from its last high, but Nifty is at all-time high. So obviously, this does convey that the world of small cap is not as rosy as it may look. Obviously, and hence it requires a very apt and prominent discovery. But from the point of view of learnings of year 2022, you have been kind of evolving over years and kind of adding on to your learnings. And many times, many fund managers I have seen over last, especially 1 year, have not even beaten the benchmark. So it's not that Nifty small cap 250 has fallen, but portfolios have actually fallen more than that, much more than that. So there is no alpha, and it is across the board. So why is that? Why fund managers are unable to actually kind of make up and keep the alpha over last year, over 2022, many investors say that years like 2020 and 21 were easier years. Everything was going up. Fund managers also kind of managed. But a year like 2022, fund managers have actually not done well, and hence these investors are leaning towards investing in index funds. So they believe that investing into a far diversified small cap index fund is a better way of kind of investing your money at lower cost than giving it to a fund manager for active management in a concentrated portfolio. How would you address the overall context of year 2022 in this regards?
Okay, so I won't be able to speak about any other fund manager, but see what I believe is that large diversified 250 stock small cap portfolio and playing the index, uh, at best, history suggests is will kind of you'll match up with Nifty, because the rest of the peak, very few people are able to sell. There comes a time when this index catch up will happen. It will shoot past Nifty in terms of its growth, but that doesn't remain there for too long. Now, if you are just looking at the index, then index has all kinds of companies, as you just right now said, and you are then basically saying, okay, whenever the index goes up, I should be in a position to at that point take that sell call. How many people have been able to sell at the peak? Now, you need a concentrated portfolio because you need to know the businesses which you are investing in. You need a concentrated portfolio. You need to carry the conviction. Let's say if the market is not doing well, but the company is doing well, you need to carry the conviction. No, I don't need to sell. Market may not be doing well, but the company is actually doing well fundamentally. When the valuation catch up happens, it will be rapid. So this can only happen when you have a concentrated portfolio. How do you even monitor? And second is, why would I invest in a small cap index as an index fund? I would invest in Nifty because small caps is so large a universe that it will always have these good and bad companies, right? Now, each company here requires monitoring, each company. So typically, why, in a general way, why I think a lot of fund managers would have underperformed is because if you try to do index hugging on a day-to-day basis, I have to beat the benchmark every day, every week, every month, then that leads to short-term decisions. Trust me, because we need to have regulatorily, we need to have a benchmark. We display our benchmark, but internally we are driven by an absolute return strategy that no matter where the Nifty is, or Nifty small cap 100 is, or Nifty 50 is, our clients, we want, our endeavor is always that they should generate credible returns. Over a period of time, the outperformance with the benchmark shows up. But when we are doing it, we are not trying to say every day beat or every month beat the our benchmark. That's not our style, and that should not be the style when you invest in small caps. Small caps can take some. So you curate first of all. You don't need to be invested in 250 small caps through the small cap index. Rather than you're better off, in my opinion, investing in Nifty ETF. But when you invest in small caps, you need to curate. You need to have a reasonable size portfolio. It is not, if not 15, max 20. Can't have more than 20 stocks in a small cap portfolio. Then you need to monitor, and your winners, as much as you need a conviction to, as much as you want to weed out your underperformers, you sell out your underperforming companies, you also have to back your winners all the way. Now, that conviction to back them all the way also comes from the fact that you know what is happening and how you are basically doing a lot of homework and covering a lot of adjacencies around the business that you are invested in, which gives you the comfort that the thesis is playing out well, and therefore you can hold, or you can partly exit and partly ride the remainder of the way. So that is the difference. I'm not really sure why anybody should be investing in just because of low cost index, a small cap index.
Sure. So, if we do a conversation with fund managers that we do every week and ask them, please pick top three sectors for, say, next 3 years, 4 years, 5 years in this decade. And first of all, everyone is bullish about India's economy. I'm also bullish, right? So that's not a point of debate. But within that, everybody says that the top sector is financial services, because financial
Yeah.
services is going to be the backbone. Now, when
Yeah.
it comes to investing in small caps, maybe it is my lack of knowledge, but I see there are not many companies which come from financial services as a business. So that so don't you think, if one goes in investing in small caps, obviously, one misses a very large potential contributor to the growth in GDP and then obviously growth in the market caps, which is financial services.
No, 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 no. There are plays in financial services, financials in the small cap space. Across the timelines we have invested, we invested first one years ago, I think in the second year or 2.5 years after we started our PMS. We invested in Canfin Homes. We have invested in we invested in Development Credit Bank, rode those cycles last cycle. Then uh, even currently, we are invested in one company. As I said, since we are still active, I don't want to talk about it. But so smaller, nimble-footed banks, NBFCs. We invested in CDSL. When later on the market categorized CDSL as a platform. It was a big multiplier, I think 6x. We made and we exited. So even today, I can tell you that there are companies which are absolutely in the financial sector. They are doing a wonderful job. By the time they get noticed, perhaps they'll be mid caps. Their uniqueness will get noticed. The business uniqueness. We've been able to go see and get that comfort that this company, this particular company has that. And then from there, so typically it takes 2-3 years for the big re-rating to come by. And for that, people would want to see consistently what is the differential aspect. Big banks versus a smaller, more nimble-footed guy. What is he doing differently? And that's where you will get. There is a housing finance company we love, which we are invested in. We are invested in two financial companies in our so the way they do business, the way we know that it's the growth as well as the the efficiency of the business is going to be, will keep increase, efficiency will keep getting better, and there is a healthy growth that is happening. So and these are all sub 8,000 crore market cap companies. So I'm talking about my universe. And absolutely there are players, and they'll keep coming because the larger players will not go and embrace technology. Because they are elephants, they move slowly. It is the smaller ones, you can call them the cheetahs, who we have to find out who's the right cheetah who can ride. So that's how you would invest. There is an opportunity. Okay, if somebody says I have a small cap only financials fund, then you won't have. But in a 12 to 15 stock portfolio that our clients have, they will always have one or two financial companies for sure.
Right.
I'm seeing some questions very quickly. I can order.
Yeah,
The churn, first one is average churn rate. So churn rate is very low. We invest for the long term. So in the first couple of years, though, we only will perhaps weed out any underperformer. In the typically fourth, fifth year is when the first set of companies that we've bought that will get sold out. So those years will see a one level of churn to reinvest. Performance, yes, it is net of expenses. Portfolio level max drawdown experienced was in post-COVID times about 35-37% in some of our client portfolios. Overall portfolio would be slightly lesser, but the client portfolio level I'm talking about. So any examples you could give of companies where external environment changed? So one of the biggest change was COVID, where we had to get out of travel and leisure companies, which we were invested in. No, we don't invest in unlisted companies at unlisted stage. Will digital rupee? In fact, this was our topic of discussion in the morning meeting today. It's too early to say what will happen, but wallet business can be impacted. So those who are pure wallets, if government is giving me the comfort that my rupee is secure, I can do it as conveniently as pay as wallet. But it's going to take some time before we know the real impact of this digital rupee. What is the beta range of your small cap PMS since inception? This is something which I don't have it handy, but we will relay it to Kamal, and perhaps he can pass it on to you. Our team, what is the setup of your team? So my team, including investment team, including myself, we are 7 people. My youngest colleague would be about 9-10 years of buy side experience. So in that way, we have a very experienced team. Uh, then we have, of course, compliance, head of our operations, and all the equity dealers, etc. So it's a fully institutional setup that we have. When should we exit small caps, or how can we time the exit from small caps? So this is what I was talking about. I'm sure this question got answered. You go by thesis. When the thesis plays out, please consider an exit. What are your views on small companies in manufacturing and reporting low value medical equipments? Couple of years. So Polymedicure is one of our holdings, by the way. Medical devices holdings. We are looking at the company. Polymedicure is there with us for almost 3.5 years now. So it's one of our key holdings. Then what were your actions, thoughts during March 2020? Good question. So what we did is, as soon as we knew that this COVID is going to have a long-term impact, we sat down, we looked at our portfolio, and we said that which are the companies which are going to, because this pandemic and that fear, it was very clear that nobody knew as to what level of restrictions will come. It was very clear that it's going to be a global event. So we sat down, we looked at all our companies and said that which are the companies where in this environment there could be a medium to long-term impact, and we sold those companies out. We sold post in April 2020 because end of March, when this became clear, we took a few days to do this analysis, and then once the markets tanked and then they kind of recovered, that's the time in the next 2 months we sold out and we reinvested. That's when we bought Tejas, where we found COVID perhaps as a more tailwind. The COVID happening was a tailwind for their business. So that is there. Somebody said, please Hindi mein baat kare. So if anybody wants to me to have any specific question in Hindi, I can obviously switch to Hindi. Yeah, I think those are the questions. What are the 9 rivers? They are all big rivers that crisscross the length and breadth of India. आप गिन लीजिए, मिल जाएंगी सारी, और हमारे वेबसाइट पे भी लिखी हुई है.
Do all your clients have same portfolios when they have come at the same time?
Yeah, so the clients who come on the same day, same legacy, will have the same portfolio. But since we have guardrails where we don't buy stocks at high valuations, once the stocks go beyond our valuation comfort zone, we stop buying. So either they have to correct, or if they jump orbits, go somewhere else where we don't want to enter at those valuations, then a new stock features in a new client's portfolio. Having said that, as I said, we don't have hundreds of companies in all our portfolio. There are only about 2 dozen, maybe 25 companies today, shared by all clients, each client having 12 to 15 companies.
Despite such stellar returns, why the AUMs have not grown so much? AUMs are low.
So it's both ways. One is that they are pure small caps. So, after a client completes 5-6 years, given the, once you see very healthy mid-20s, net returns, clients do want to take money out, and we don't discourage. So that is one of the reasons that we also have, once the 5-year cycle gets completed, clients want to see money in, profits from the portfolio booked, although we book profits, but they feel that profits have not come home. So that's one. Second is, this is not a strategy where you can take a lot of money. I have to humbly submit that we are good to manage about 750-800 crores of AUM, not more than that in small caps. Because small caps, if it's a large AUM, you will come under investment pressure, which means you will either compromise your quality for getting cheaper valuations, or you will overpay to buy a good business. And we've seen with so many others who have done that, right? So it is not a great idea to, this is not a AUM chasing strategy. This is a strategy, we chase returns. And if you want to chase returns, you need moderate AUM. And you also need to grow this AUM in a moderated way. Suppose somebody comes and gives me tomorrow, a big chunk of money. Some say private wealth firm says, okay, here is my clients, and tomorrow I'm giving you 200 crores to deploy. It will take me a lot of time to deploy. It's not that you can be deploying this in small caps overnight or even in a month or two. We've taken, depending on the state of the market, if the markets were reasonable, we take 4 to 6 weeks to create a client portfolio. when the markets are berserk, go back in 2017, we have taken 5.5, 6 months to create that 12 to 15 stock portfolio. Those are the clients who we onboarded then. So it's anyway not a high AUM strategy, and we are happy to build it gradually.
Right, Sandeep, I think, to sum it up to, all the audience, see, we are living in obviously, uncertain times, but if a small cap business is discovered, with right, I would say, ideology in terms of sector selection, and then, business itself comes from some of the kind of prominent themes like Sandeep talked about, be it manufacturing, be it defense, and then obviously one keeps on, kind of vigil in terms of trying to churn the portfolio very intelligently, be it COVID times or be it euphoric times, and then is able to maintain both earnings growth as well as the valuation of the portfolio. Obviously, with a longer term horizon, one can make tremendous wealth, and that's what Nine Rivers and many other small cap focused portfolios would have done. And besides this, obviously, it is important to make an objective selection while investing into a PMS product, because it's meant, for high performance investing, and high performance comes at high risk. And that is exactly, where PMS AIF World, that's our platform, we specialize and we deep dive these strategies for all those unanswered questions, which have not been covered in this session. You can contact us. I have shared the book a call link on the chat box. Also, there is a offer button, which is going on. You could press that and book an appointment with us, or you could visit PMS AIF World platform. We can connect business with many clients all over India over last 5 years, and have been managing healthy pool of assets. But we focus very, very, I would say, carefully, when we advise our clients, and that is exactly where we have been doing these webinars every Friday, and the rhythm goes on. Thank you everyone for joining us today, and thank you, Sandeep, for sharing your time. Your presentation has been very, very, I think, detailed. There was less scope to ask questions, but I think this went on still for more than 1 hour, because we covered every aspect of your process, of all the, I would say, experiences that you would have had and learnings you would have over years. Thank you everyone once again. Have a
Thank you,
nice
Kamal,
weekend.
and thank you everybody for patiently listening to me. Have a great evening and a great weekend. Goodbye.